Hi, Steve Schlagel here. Just recently, the Supreme Court affirmed what we call ObamaCare, or the Health Care Act. And I've talked before about the tax consequences of that, and I want to reiterate that just so that you can take advantage of any opportunities you have before the end of the year. Because at the end of 2012, beginning of 2013, there are substantial changes in tax law. And one of them that affects everyone, not just the well-to-do that the media tells us about, but everyone, is an increase in tax rates. And I don't care if you're making $20,000 a year or $2 million a year, your tax rates are going up. All of the tax brackets have increased, and everyone's going to pay proportionately more tax. Further, right now we have a payroll tax holiday, if you will, a 2% reduction in Social Security taxes paid by employees, or that comes out of your paychecks. That's likely going to go away at the end of the year. It's scheduled to go away. And so you'll have some additional tax to pay there. Another unfortunate change was an increase in the capital gains tax rate. It used to be somewhere between 0 and 15%. Depending on your tax bracket. Now that rate's going to go to 20% rather than 15%, and it's also going to be subject to this new additional Medicare tax on investment income. And that new Medicare additional tax is an additional 3.8% tax for well-to-do individuals, people making more than $250,000 as a married couple, or $200,000 as a single individual, but there's this additional 3.8% tax on interest, dividends, capital gains transactions, rental income, passive activity income, and royalties. And so it's very broad and pervasive, and that 3.8 gets added on to your capital gains rate of 20%, so you're at almost 24% on capital gain transactions, which means if you've got some appreciated property, stocks, bonds, real estate, whatever, that you're thinking about selling in the not terribly distant future, get it done before year end so that you can lock in that 15% rate rather than getting hit with that higher, nearly 24% rate. So that's going to be some additional tax that we have to pay. The other side of it is if you have properties that have built-in losses that you were thinking about selling, those losses might be better used in 2013 because those losses and other deductions are going to be worth more to you. You get a bigger deduction for them when the tax rates are higher in 2013. So just a little brief introduction to some of the impacts of the new Health Care Act and how they affect us and how the expiration of the Bush tax cuts affects us as of the end of December 2012, not that far away. Be sure that you visit with your tax planner or tax advisor to get the advice that you need to make good decisions before year end.